All right, so the market basically closing flat this afternoon. Chantal Marx from FNB Wealth and Investments joins us. Chantal, thanks indeed for your time. So the rand falling sharply against the US dollar this afternoon, and I mean, what, 2.5% down on the dollar, and everyone's pointing to JP Morgan recommending a rand sell-off. What's the story there?
So I think it's a combination of factors. The JP Morgan report actually came out yesterday and would have explained a kind of a similar move and perhaps partially the move that we saw today. Basically, JP Morgan has said that South Africa's terms of trade from here on out are probably going to start deteriorating. And by that, I think the implication is that commodity prices have been very high. This has been very supportive of South Africa's terms of trade and, by extension, the rand. And if commodity prices are going to start coming under pressure soon, especially with the oil price remaining quite high, of which South Africa is a net importer, then you could see a deterioration in exactly the factor that has been holding up the rand. And I think that this is clear when you look at the rand movements today relative to other major currencies. The oil importers are all under pressure. The oil exporters are all seeing their currencies a lot stronger today.
Yeah, indeed. So the giant commercial property group Growthpoint releasing results, Chantal. Because of COVID, you had these occupancy rates worsening, but there was a dividend, revenue is up, and I suppose Hyprop telling us more or less the same story of resilience.
Yes, so the trends that we've been seeing in the South African property sector really coming through in Growthpoint, which is no surprise, it being the largest and one of the most diverse property groups in the country. What we are seeing is that rentals are coming under pressure in terms of renewals. Thankfully, when rentals are being renewed at lower initial rates, you are still seeing positive in-contract escalations, which means in the years ahead, those rentals are expected to increase. Vacancies are still quite high, particularly in the office space. Also, a very natural consequence of where we find ourselves currently. A lot of people, including myself, haven't been in the office for over a year now. And I think companies are still waiting to see whether or not people are actually going to return to work to the extent that they were filling up office space prior to the pandemic. I think what really counts in their favor is the fact that you've seen a really big improvement in the retail sector, and footfall continues to improve, tenant turnover continues to improve. And all of that has improved cash flows to the extent where debt is starting to come down and they're able to start or they're able to maintain the payment of dividends.
So another dipstick into the COVID-19 effect. We've got RMI, which has the firms like Outsurance underneath it. It was an update from them, and it's interesting to see how the insurance industry has been going through COVID.
Yes, the insurance industry has actually proven to be quite resilient. So we have seen the life insurers take a bit of a knock because they initially underestimated the mortality experience or the number of death claims that they were going to get from COVID, particularly in this third wave. But it seems as if the life insurers are starting to get a better grip on how they need to model and price for this elevated risk. Similarly, the short-term insurers are also getting a better grip of what conditions are in terms of business interruption claims and all the rest of it. So I think that that is displayed in this update. You do have them guiding for an increase in normalized headline earnings per share, which is basically their normalized profit of between 10 and 20%, which seems quite decent given current conditions, and it speaks to a reasonable underlying result or underwriting results rather from Outsurance.
And then Chantal, just very briefly, I've got a few seconds before you go. We saw the rand weakening and then the oil price here escalating. I'm just wondering what inflationary impact that's going to have very briefly.
Yes, so the oil market is quite tight at the moment. Again, a combination of factors, the biggest probably being a week or so ago when we had a massive hurricane hit the coast of North America, which had an impact on production there. And then today we saw an inventory report out of the US signaling that they are using up oil very, very quickly. And that points to supply coming under a little bit of pressure. And of course, when supply is under pressure and demand is still high, the price goes up. I think the only thing that will kind of limit oil price increases at this point is going to be increased production, perhaps from the powers of OPEC, and then or an economic slowdown, which I think will probably do more bad than good.
Yeah, indeed. Well, Chantal Marx from FNB Wealth and Investments, thanks very much indeed for those insights. Let's take